Hey guys, Kayan Kalipha here. Just want to share with you guys a key point to train the Forex market successfully, and that is interest rates. I've just created a new video explaining a lot of currency moves that are happening in the market right now with the US dollar because of interest rates going up around the world to deal with this high inflation that many countries are dealing with because of the pandemic. And I really want you to understand how interest rates affect currency moves because it will help you trade the markets professionally. So watch this video, enjoy interest rates, and come and join my trading team after on a 60-day free trial and follow all my personal trades and get my daily video analysis. Thank you. Okay guys, so welcome to today's video. Really excited to break down interest rates with you. I'm going to explain why interest rates drive the Forex markets, why we always have to pay close attention to the market expectations for what central banks are going to be doing with interest rates. We have to look at the interest rates on government bonds, and then we have to pay close attention to inflation because inflation is going to be the reason why interest rates are either going up or down in a country. And I'm going to explain why we are always trying to buy a currency with a higher interest rate than another currency to get a really good trade idea in the currency markets. So let's first of all start off with looking at an economy. So I'm going to give you a really good example of looking at the Mexican peso, which is the currency for Mexico, which has been getting extremely strong over the past 2 years. And I'm going to explain why fundamentally investors are very attracted to buying the Mexican peso right now, because there's two factors driving this. At the moment, Mexico Central Bank has a 3% inflation target. Inflation in Mexico is at 6.24%. That's double the central bank's target. So when inflation is too high, the central banks want to bring down inflation back towards their target. And what they do is they raise interest rates. As you know, guys, when you raise interest rates in an economy, that's going to increase people's mortgage payments, credit card payments, student loan payments, car loan payments. All payments in the economy for people who have borrowed money are going to go up at the same time. It reduces their capacity to spend, and that basically brings down the demand for spending, and then inflation will come back down to target. And what that actually means is that when we're trading currencies, this gives us a really good opportunity to make money from interest rates going up in a currency, in a country, because it makes the currency very, very attractive to investors. So at the moment in Mexico, the interest rate is 5%. And by next year, 2022, we're expecting rates to go up to 5.5%, 5.75%, 6%, and then up to 7%. And that's because inflation is already at 6.5% and it's quite high at the moment. So basically the central bank wants to bring the interest rate above inflation to bring down inflation, okay? And what we've seen is, we've seen the Mexican peso get extremely strong, for an example, against the euro. So you've seen, when we look at this currency pair and we look at the way this has been trending for quite a while, we can see, for an example, that the Mexican peso has strengthened against the euro by over 15% over the past nearly 2 years. Over the past 2 years, in 2021, for this year alone, we've seen the currency pair strengthen in value by around 3.5% since the beginning of the year, but you can see the trend continues to go to the downside. So why is the Mexican peso getting stronger against the euro? Why has the Mexican peso been getting stronger against the US dollar? You can see exactly the same situation where the Mexican peso has been in a long-term downtrend for nearly 2 years now, and I'm going to break down this for you in more detail. So what we need to understand is that interest rates are basically how much you'll be paid if you buy a currency over 365 days, or how much you'll be charged if you borrow a currency over 365 days. So what that basically means is, if we are trading a currency pair in the Forex markets, what we need to remember is that you're always buying a currency and selling a currency simultaneously at the same time. So what I mean by that is, if we take euro and we take the Mexican peso, and if the interest rate is going to go up to 7%, as I was just showing you in the chart there, Europe's interest rate right now is minus 0.56%. So if I buy the euro in a trade, if I want to buy the euro in anticipation that the euro is going to go up in value, I would have to first of all own the Mexican peso, sell it in exchange to buy the euro, and I'm going to receive no interest on the euros that I purchased, but I'll be charged 7% interest on the Mexican pesos that I borrowed to buy the euro. Because remember, you're looking at an exchange rate. You're looking at one currency against another currency. So if I want to buy the Mexican peso against the euro, or buy the euro against the Mexican peso, I'm either going to have to borrow one currency and sell it in exchange to buy the other currency. And the interest rate either means you're going to get paid interest when you buy the currency, or you're going to be charged interest when you borrow the currency, okay? And that basically means that if I'm buying the euro against the Mexican peso, I get no interest paid to me over 365 days. This is the interest rate for a 1 year time, but I'll be charged 7%. So if you have any sense of numbers, you will know if I sell the Mexican peso to buy the euro, I'm going to be losing 7.5% over 365 days over 1 year's period. Why on earth would I ever take a trade where I would lose 7.5% on the value of the money that I've invested over that period of time? So basically, as soon as you buy that currency pair in the euro's favor, you're losing money every single day you hold that trade open. That doesn't make any sense. If I was taking a one lot position in this currency pair, that means I'll be losing $21 every single day. Now imagine, guys, if you are a massive hedge fund, and you take a position of, for an example, 10 lots, and you're trading a million, for an example, yeah? You're trading a million. Now you're losing $219 every single day you hold that trade open, for an example. So clearly, it's not profitable to buy the euro against Mexican peso because I lose money every day. If you lose your brain, you would just say, well, why don't I take the euro and sell the euro in exchange to buy the Mexican peso, and I pay no interest on the euros that I borrow, but I get paid 7% interest on the Mexican pesos that I purchase, so I'll make 7.5%. Now remember, that 7.5% is credited into your trading account over 365 days. So it would work out, if I bought a 1 million position, that I'd make $219 every day. Every single day, the broker would have to credit that into my trading account just for holding the trade open, even if the exchange rate didn't even move a single inch in the currency pair. You're still going to make that return. So then imagine when investors are seeing that interest rates are going up in Mexico, and they're seeing, oh, if I sell the euro and I buy the Mexican peso and interest rates keep going up, that means I'm going to keep getting paid even more interest over a 1 year period. So what do all the investors all around the world do? They go and they rush into this trade, and they borrow euros, they sell euros in exchange to buy the Mexican peso, and then you have a trending market where the currency pair goes down by 15%, for an example. Now, let's imagine that you've made 15% on your trade, plus you've made 7% interest over that same period of time. So now you're talking maybe a 20% return on your money. Now think about institutional money, hedge funds, investment banks who are dealing with billions of dollars. Imagine you getting 20% return on your money on a trade on $1 billion portfolio. That's big money. You're talking nearly 200 million. That is why interest rates drive the currency markets. We've been seeing this playing out all over the world right now. This is why I've been trading so many currency pairs, making money with my members, because, for an example, at the moment in the United States, why is the dollar so strong against the euro right now? Why did I actually take this trade this week and I closed this trade with my members and we made a profit? It's because of inflation in the US being high and markets betting that the US central bank is going to be raising interest rates. So here's another example. In the United States right now, inflation's gone up to 6.2%, very high above the central bank's 2% target, and the markets are betting that there's going to be a rate hike by the central bank in June of next year and then December of next year. So what that would mean is, if I was to take euros and sell euros in exchange to buy dollars, even though the US dollar's interest rate will not be as high as Mexico, I would still get paid money if I take that trade in the dollar's favor. If I sell euros and I buy dollars, I'm going to make 1.31%. That is what's driving this currency pair to the downside. Investors are never going to take a trade where they're going to be selling the currency with a higher interest rate and buying a currency with a lower interest rate. It doesn't make any sense. You're losing money every single day you hold that trade open. So interest rates are what are driving the currency markets, because you get paid this difference overnight when you're holding a position in the markets. Another position right now, which is playing out really nicely, the euro against the Russian ruble, here's another example why I'm always selling the euro to buy other currencies, because Europe has negative interest rates, which basically means I actually get paid by the broker to sell the euro and buy another currency, and then I'll get paid by the other currency I'm buying if it has a higher interest rate than Europe. So you can see at the moment, if you look at Russia, for a prime example, Russia at the moment, their inflation's high at 8%. The central bank, you can see inflation is 8%. Their target's 4%. The central bank has an interest rate right now of around 7.5%, but is expected to go up to 8.5% by next year. Now think about that difference in interest rates, as I was just explaining to you. If I take that trade and I can get 8.5% if I buy the ruble against the euro, I can make 9% on my on my trade, just even if the exchange rate doesn't move. And that's why the exchange rate is already moving in 2021. And you can see that the currency pair currently has already gone down by now 8%. Now add on 8% to your 9%. Now you're looking at a 17% return on your money. Now you can see what's driving the markets. And the good thing about this trade is, guys, is that this trend has only just started. There's still a lot of room to move from when the pandemic started, for the Russian ruble to strengthen against the ruble. So that's one reason why interest rates are very important. So we're always looking at countries where central banks are not talking about raising interest rates, they're talking about keeping interest rates very low. And these countries are like Japan, Europe, for another example, European Union, that is, so for the euro, and Switzerland, Sweden. These central banks are not indicating rates are going up. But in other countries like the United Kingdom, the United States, Canada, Norway, Mexico, Russia, Brazil, New Zealand, these central banks are all talking about raising interest rates. And that's why I, with my members, have been, for an example, selling euro New Zealand dollar, which we're in a really good trade right now, and we're in a really good profit. And the reason this is trending lower is because, again, the reason behind it is the same reason I'm just showing you guys. In New Zealand right now, inflation is at 4.9%, above the central bank's 2% target, and markets are betting on a rate hike this month in November to go up to 0.75%, and by next year this time will be at 2.5%. So again, investors are looking at the opportunity to sell the euro, buy the New Zealand dollar, get 2.5% interest on that trade. Thank you very much. I make 3% return on my money, and then at the same time in 2021 we've already seen the exchange rate, for an example, go down by 6-7%. Now I can make a 9% return on this trade. But if interest rates are still going up even more in New Zealand, you can bet your bottom dollar that this currency pair is going to keep trending and we can keep making money on the way down. This is how you trade the currency markets, guys. This is how you do it professionally. This is the fundamentals behind trends in markets. And then of course we can use technical analysis on top of fundamental analysis to catch the trends where we time our trades in the markets. Now another end of the interest rate spectrum is government bonds. So if you are an investor, so let's say you don't want to take speculative trades in currencies, you don't want to take speculative trades in stocks, crypto, commodities, you don't like to risk losing your money. So what do you want to do? A lot of pension funds, insurance companies, governments, people with very large amounts of money, they just want to put invest their money in a secure place where there's no risk. They can guarantee to get the money back, a little bit of interest, as long as the interest can keep them above the level of inflation. So the dollars or whatever currency they're investing keeps their purchasing power. They're going to buy government debt. Of course, for an example, investors love to buy US debt, for an example. So the interest rate on the US debt right now is 1.61%. You can see it here on the right hand side. And you've been seeing the US interest rate going up this year, and there's no surprise it's been going up on government debt, because in the United States, as I was just showing you guys, there's very high inflation. So as inflation has been creeping since the beginning of the year, 1.4% down up now to 6.2%, investors are demanding a higher interest rate if they borrow money to the government, because they're saying, well, come on, I don't want to be owning a bond that doesn't earn any interest above inflation, because basically I'm losing my invested money to inflation. So the interest rate's been rising. Now, what you see is, if you're looking at countries in places like Europe, where they are starting to look, so think if you're an investor in Europe, if you're an investor in Japan, if you're an investor in Sweden, if you're an investor in Switzerland, you want to invest your money, you want to only invest in bonds, for an example, you don't want to invest in stocks, currencies, commodities, crypto. you're always going to be looking around the world and saying, okay, so who's got the higher interest rate? Where can I invest my money? Where's the safest place to invest my money? So if interest rates start to go higher in the US and you're a European investor, in Europe right now, as we speak today, investors in Europe, if they buy government debt in Europe, are receiving no interest, minus 0.26%. So I can't buy European debt because I get no interest paid to me. If I'm in Japan and I want to buy a government bond, how much interest am I getting? 0.06%, zero interest. If I live in Switzerland, how much interest am I getting? Minus 0.16%. I get paid no interest. So you've got all these investors in Japan, Europe, Switzerland, for an example, looking for a place to park their money, and they're looking right now in the United States and seeing the interest rate in the US go higher. And look what happens in the currency markets when government interest rates start to go higher. So here we have the European interest rate on European bonds, and we have the US interest rate, and we have the difference highlighted in blue, column B, by just taking the European rate and minus the US rate, and then we put Euro USD on top of this on this chart here. So Euro USD, so the US interest rate over Europe's interest rate is highlighted in blue, and then we have the exchange rate highlighted in orange. Now, what can you see? As the US interest rate is higher than Europe because it's Europe minus the United States, so it goes down in the chart. So you can see as the blue line goes down, this means that the US interest rate relative to Europe is better, is going higher. Look what happens to the currency pair. Investors in Europe are selling their euros, buying US dollars to buy government debt in the US, and in the process of selling euros and buying US dollars, it causes the currency pair to strengthen as the interest rate is going in the dollar's favor. Look what happens as soon as the interest rate starts to weaken in the dollar's favor, so it's not as profitable, the euro starts to strengthen against the US dollar. As soon as it starts to go back in the US dollar's favor again, look what happens. The currency pair turns over and the US dollar starts to strengthen against the euro. And that is the fundamental reason why just this week I placed a trade with my members. We made a good profit on the Euro USD. And that was the fundamental reason behind it. As soon as the US inflation came out strong, investors are obviously going to demand a higher interest rate. And I knew automatically how you're going to get investors all around Europe looking at that higher interest rate and selling euros, buying dollars. We jumped in that trade and we made a profit. So that was the fundamental downtrend happening. Euro against the US dollar. Okay, you can see this with so many currency pairs. The US dollar against the Japanese yen. This time you look at the US interest rate minus the Japanese interest rate, and then you put USDJPY. So as the interest rate is going higher in the US dollar's favor, highlighted in blue, and then the currency pair follows this differential. And when it narrows, not as favorable in the US, the currency pair weakens, so the yen strengthens against the dollar. But as soon as it picks up again, look what happens. The currency pair picks up again. They literally mirror each other perfectly. You can see this in any exchange rate. Here's a US Swiss franc, same thing. US interest rates relative to Switzerland's. Look, the blue line represents the difference. Look at the currency pair, literally this mirror image, and follow the differential. So all you got to remember, guys, interest rates are either going to give currency traders the opportunity to buy and sell currencies and get the interest paid into their trading account over 365 days, as I explained. Or you think about it in the other spectrum, and you think about big institutional money. Pension funds, insurance companies chasing that higher interest rate and selling one currency, buying another currency and parking their money in that country. And that's what's driving the currency markets as well. So this is just a short video explaining interest rates. If you don't understand this, and let's say you're trying to trade technical analysis and you don't even know what's going on, guys, you're going to lose money. You're going to get caught out in currency trades. You're not going to understand what's driving the markets. And this is why I'm always trying to feed this to my members and give them a good fundamental base to know how to trade currency successfully. So we jump in trades and we win when we're getting into the markets. So guys, again, listen, if you want to come trade with me on a 30-day free trial, you don't have to pay. You can come trade with me, follow my trades, follow my daily video analysis where I'm sharing a lot of information with members and giving them analysis. I have a free channel on Telegram if you want to come and join, and I'm posting videos in there every day, just giving some free material a way to help people. So for an example, I will post some videos in this free channel, for an example, some information, some written descriptions, and this is the same kind of stuff I give to my members. Plus, I obviously give them the trades that I take in the markets and they can follow. And again, it's a 30-day free trial. Even if you've never traded before, we show you how to open a trading account, show you how to place a trade, show you about risk management, so you're never going to lose all your money trading with me. And it's important, guys, that you get invested, because right now, interest rates are so low all around the world that are like 0% and you're getting no interest, but come and make a 20-30% return trading with me and you've grown your money. Okay guys, listen, thank you for watching. I hope that was informative for you and you enjoyed it. Send me a message, come get involved, and I'll speak to you shortly.